When you hear S&P 500, you probably think it's a list of the 500 biggest US companies. But here's the twist. The S&P 500 actually includes more than 500 stocks, currently 503. That's because some companies like Alphabet, Google's parent, issue multiple classes of stock, each counted separately in the index. For example, both Google and Goog are in the S&P 500. Why? Different share classes often give founders more voting power. So, while there are 500 companies, the index tracks a few extra stocks. This detail matters. When you invest in an S&P 500 fund, you're buying a portfolio that mirrors the real market, including all those share classes. The 500 inches refers to companies, not stocks. Knowing this gives you an edge. Most people don't realize it. The S&P 500 is a snapshot of the US market, and understanding its structure is your first step to smart investing. Now let's see how a company gets into this exclusive club. Companies can't just join the S&P 500, they have to be invited by a committee at Standard & Poor's. The main requirement? Size. A company needs a market cap of at least $18 billion, but that's not all. The company must be US-based, have at least half its shares publicly traded, and show consistent profits. Liquidity matters too. The stock must trade actively so big investors can buy or sell without wild price swings. The committee reviews the list regularly. If a company shrinks, gets acquired, or stumbles financially, it can be replaced. This keeps the S&P 500 current, a living, breathing reflection of America's biggest businesses. The index is market cap weighted. Bigger companies like Apple and Microsoft have more influence on its value. A 1% move in Apple moves the index far more than a 1% move in a smaller company. Understanding this weighting is key to knowing how your investment performs. Next, let's talk about how you can actually invest in the S&P 500. Want to invest in the S&P 500? You don't buy 503 stocks individually, you buy an S&P 500 index fund. An index fund holds all the stocks in the S&P 500 in the same proportions as the index. It's like buying a single share of the entire market. Simple, smart, and efficient. You're not trying to beat the market, you're matching it, harnessing the growth of America's top companies. Most pros who try to beat the market fail, and charge high fees for the privilege. Index funds offer instant diversification and a built-in safety net. If one company struggles, hundreds of others balance it out. Historically, the S&P 500 has returned about 10% per year over the long run. Matching the market isn't settling, it's a proven path to wealth. Next, let's break down the different types of S&P 500 funds you can buy. Scene transition. There are three main ways to invest in the S&P 500. Mutual funds, ETFs, and unit investment trusts, UITs. Mutual funds are the old school option. You buy shares at the end of the day. ETFs are the modern favorite. They trade like stocks so you can buy or sell anytime the market's open. The three biggest S&P 500 ETFs are SPY, IV, and VOO. All track the same index but differ in structure and fees. SPY is a UIT, which means it pays out dividends in cash and has a slightly higher expense ratio. VOO and IVV are regular ETFs. They can reinvest dividends and have ultra-low expense ratios. Expense ratio is key. VOO and IVV charge just 0.03% per year, while SPY charges 0.09%. That tiny difference adds up over decades. Choose the fund with the lowest fees to keep more money working for you. Next, let's talk about what really matters when you invest. Here's the bottom line. The most important factor when choosing an S&P 500 fund is the expense ratio. Share price doesn't matter. What counts is how much you pay in fees each year. Lower fees mean more of your money stays invested and compounds over time. Pick a fund like VOO or IVV with a 0.03% expense ratio, and you'll keep more of your returns. Investing doesn't have to be complicated. Don't let anyone sell you expensive products you don't need. Open a brokerage account, start with what you can, and buy a low-cost S&P 500 ETF. Keep adding to it, stay calm during market swings, and stick to your plan. This is your path to financial freedom. You're ready, now take action. What's holding you back from starting your investment journey today?